Smarter credit and debit card strategies should evolve alongside upgrades for payment platforms. Should FIs rely on in house expertise to navigate these complexities or rely on vendor partners? Let's explore the answer on the BAI Banking Strategies podcast. I'm Rachel Koning-Beals, Senior Editor at BAI, and this is the BAI Banking Strategies Podcast. Joe Schmithorst, Vice President of Product and Client Strategy at Primax, joins our podcast to encourage banking leaders to ask the right questions as business and retail customers seek updated payments capabilities. There can be a lot to consider, from costs to data sharing and more. And that's why choosing vendors wisely is key. So, Joe, your background gives you a unique perspective on the challenges banks face with payments today. Could you walk us through some of the key complexities that banks are grappling with and how we arrived at this point?
With my background, I saw the complexities and the hurdles and just some of those decision points that banks had to make, whether it be a larger bank or a smaller financial institution. And we really looked at like payments as a whole, but then narrowing in on your debit and credit card processors and how do you make those decisions. And I think a big part of it is there's so many options and it gets a little daunting, whether it be your payment strategy or does your credit card fit into your payment strategy or is credit card separate from payment strategy. So a lot of those conversations are happening. I think more specifically around the credit card piece is just the understanding of all the decisions that need to be made in order to launch a credit card. How we got here, though, is there's just a lot of options, and the ability to sift through all those options and make a clean decision is tough.
Banks have to join with a third party regardless. Does it have a lot to do with then a regulatory piece to it?
There's the regulatory component of it, the lending aspect of unsecured lending. There's regulatory, the compliance piece of it. Then there's the which vendor do we select to help us go through all this? And is it Visa, MasterCard, Amex? And do we own our own BIN? Do we share a BIN? And there's kind of three traditional models. There's the agent bank model where the financial institution takes absolutely no risk, but they get a white label card that a third party is going to issue on their behalf. But they also do not own the customer experience and they don't get any of the revenue from interchange, finance charge, or fees. So there's that balancing act of, okay, you don't need a lot of staff and we don't take any risk, but we get a card with our name on it. And then there's the other side of the spectrum of self-issuance where a lot of those decision points come into play in terms of what BIN do we want through which network, which processing vendor are we going to pick, which tech stack, how do we want to integrate that into our digital banking. So all those decisions. But once that kind of hard process of making those decisions and getting it set up, then the revenue starts to flow through and you own the customer experience and the marketing and all that stuff. And then the third one that we're starting to see is a hybrid model where it's kind of a shared BIN approach. So the financial institution gets to own part of the experience. They might get to set the value proposition and all that and take on more of a revenue share agreement with the vendor. So different approaches all have pros and cons depending on the situation of the financial institution.
We have this big question out there about data sharing and knowing your customer. I'm assuming that's going to factor into kind of one of our conversations here, right? So I don't know, do you want to walk us through each of these models?
Start with the first one we talked about, agent bank, where again, it's a third party on your behalf with your financial institution's name on it. And to your point there, like data sharing is a great point of that. Like the data is not essentially yours, but the customer is walking into your branches and all that. From a customer perspective, the experience is happening, right there within your branch or digital experience. And then the self-issuance piece is when you're selecting a vendor to make sure that you understand how are they going to use your data. Because at the end of the day, in that model, that is your data. It's your customer and you should be able to access it, or it should be coming over to you via file or real time or some way, either back into your core or your enterprise data warehouse or some mechanism there. So that is a really good point there to make sure that that data is coming back into your kind of bank ecosystem. And then the hybrid, similar approach in terms of the data piece of that. Just make sure you're asking those questions in terms of where's the data flowing? How do we get access to the data? Because at the end of the day, the financial institution should be using that data too to make cross sale, the propensity models of they have a card, they've been making a lot of purchases at AutoZone. Maybe they need another car, push them an auto loan. So those types of marketing decisions can be used from those data points too.
When implementing a new payment strategy or platform, what would you consider sort of the biggest challenges bank needs to think of first?
I'd say the first thing is identifying the desired outcome that you want with the card program. What does the financial institution really want to use this card for? Is it a revenue play? We want interchange. We're tired of giving it to everybody else, and we want the finance charges and control that kind of risk model. That's one component of it. The other one could be we want to use it as a loyalty mechanism because if you think about it on average, the credit card, you're using your credit card, 15, 20, sometimes 30 times a month. Could vary based on consumer, but your name's on that card every time they pull it out, and you want to, be proud of that. They don't pull out their mortgage every month and say, "Hey, look at my mortgage card here." So it's a way of driving loyalty back into the community bank. Then it's piecing it all together of finding the right vendor, getting your bin set up, all that kind of stuff. And the big part too is there's this time in the industry right now, which is super interesting because there's somewhat of the legacy platforms, if you will, and then there's a lot of fintechs that are coming up that are all cloud based and they have all the buzzwords and that kind of thing and faster to implement and things like that. So I would say just look at all of them, look at all the different providers.
Aligning with your values and things
Yeah.
like that. Like it's sort of no easy endeavor in a lot of ways. So maybe you have some sort of best practices in that regard.
Yes. Yeah, I would say definitely during the RFI and RFP process when the financial institution is looking at different vendors, there's the tech layer of it. Like, what are you going to get from a widget perspective, if you will? And what does the interface look like? And how does it integrate into your digital banking and your core and all those types of things? That's one big component of it. But I'd say a bigger piece that often gets left out is that extension of the team and the values. And can you just pick up the phone and call your vendor and say, "Hey, we got a problem here," or "Hey, I've been thinking about this idea. What are your thoughts on this?" Or "I've seen this out in the industry. What are your thoughts on this?" That's a very critical thing that's not really concrete into an SLA or into a contract typically. But as you shop and look for the different vendors, always get referrals and references and things like that to not only understand the connectivity and the pricing and all that kind of stuff, but is this company that we potentially might partner with a good fit for our community financial institution in terms of culture, and do they pick up the phone when we call, or do they just say go enter a ticket kind of thing? So I think really understanding who you're going to do business with is very important.
Now, smartly, we always talk in these conversations about the warnings and what to watch out for, but now's the time. Let's talk about a few success stories. There's a reason we're in this business. It works usually, right? There's
That's
a
right.
reason that there's a reason to engage with partnerships. There's a reason to update your payments strategy. So, any real world examples where there was a challenge identified and there's a success story behind it?
But we've had two actually recently that have come over. One's a startup that we just started de novo, and it's doing quite well, getting the experience out there and connecting all the different technical things, but also the financial institution starting to see the revenue come through and the impact on the customer experience. And then another one was actually a transition over from an agent bank model because they were ready to take that in house. And we helped them navigate kind of the technical aspects of it. You're going to bring this in house now, and we'll help you kind of be that extension of your team. So there are two different flavors there, but both with great results so far in terms of they love seeing the revenue flow through, and it's been great to see the customer experience and the loyalty back to the financial institutions.
One thing that our research has turned up for this year in particular, but certainly going forward, is
Retail banking margins, in particular with the interest rate situation, still not as bank favorable as banks would hope, and just economic uncertainty.
Mhm.
Retail bank margins still a little crunched. So efficiencies always desired. Banks want programs that are scalable, can respond efficiently without a ton of new investment all the time.
Yes, yeah, that's a really, really good question and a good point because, yeah, as we all know, efficiency ratios and net interest margins and all that are the key things in the financial institution world. So, yes, you can scale this up, scale it down. I think the cool part about it is that if you, again, choosing the right partner and the right efficient model, you can scale it up and get the interchange revenue, the higher yields, because unsecured lend or credit typically has a higher yield because you're taking on a little bit more risk. So that helps your margins, your interest margins there. And then the fee income that comes with it too, through balance transfers or cash advances, is a good driver of non-interest income. So, you have the interchange, the fee income, and then the higher yield on the balance, which really helps the balance sheet if managed appropriately. And then two, it's an acquisition play in terms of you can go full force in the acquisition play of bringing in new accounts or scale it back, pull those different marketing levers. The same with the portfolio. If you want to drive spend, we could do some merchant category spend and get type offers to drive spend in different categories, which is always good, driving different interchange models and revenue. So there's definitely different ways to scale it up and scale it back. When that scale up comes, a lot of folks in the financial world will be like, let's go do this marketing campaign. It's like, well, time out. Are we ready to support it? And that's where it's like, have that conversation of, we're going to do this big campaign. Well, is underwriting ready to take on that additional volume, or do we have it instantly approved set up, or is back office ready to take on more calls because we're driving more awareness to the card? So we make sure that foundation's set up, but definitely opportunities to scale it up, scale it back, to drive different line items on the P&L.
Payments is evolving all the time. So I'm sure your bank clients push you a little bit too. What's next? What do you like to kind of think about? What's kind of pushing your thinking a little bit? Let's call it the near future.
Yeah, no, that's a really good question. And we get that a lot just from partners, internally, externally, all that. There is a lot going on in the payment space right now. I mean, just with regulation, legislation, the stable coin, cryptocurrency, all that fun stuff, real-time payments, all that fun stuff. And then you still have the cards over here, but there's a lot of pressure on interchange from business owners and the merchant side of the house. Just be aware of all that's going on. Just don't react to something that's happening because it's a headline or a shiny object. Do your homework, do the research. And then the interesting part about the cards perspective, which is, obviously where we come into play and can help navigate all that, is the card is not going away anytime soon. I mean, the consumer, think about, Apple Pay or Google Pay, digital wallets, the evolution it took to kind of adopt that, EMV chips, even checks, like checks still exist, cash still exists. So I think there's a lot of, when you read articles, go away credit card kind of thing, it's going away, but it's not. I mean, it's the consumers still really rely on the credit card, again, for the float of it, the rewards component of it. It's still a very strategic product for financial institutions and non-financial institutions, such as the co-brand models and all that. So I think the biggest thing that's shaping it is, right now there's just a lot of buzz. There's a lot of what could happen, what's going to happen in the long term. I guess my 2 cents or a bit of advice is just to have an awareness of what's going on, but always come back to your customer. What is your business owner looking for? What's your consumer client looking for? And build out those products and services.
Think through your card program goals. Develop vendor relationships that reflect bank card program goals. Is your program a revenue play, used for interchange, or meant to build brand awareness and loyalty? This all determines who controls the risk, the data, and other considerations, and helps you establish a beneficial partnership. Select a vendor that favors scalability. Card programs, especially versatile approaches built to scale up and down, can be key generators of fee income, interest margin, and other opportunities. Choose a vendor that helps this flexible strategy. Cards for the near future. The fast-changing payments market challenges the banking industry to respond with modernized card programs, leaving FIs to decide if card programs should exist as part of their payments platform or operate separately. Investment in these programs persists as consumers and businesses appreciate the float and rewards programs, while FIs leverage co-branded marketing opportunities. I want to thank Primax's Joe Schmithorst for joining us today with insight on card payment strategies at the bank, including what he sees ahead for this business line. And thank you all for tuning in.